Yes, they have these massive first-day pops, which are used to saying, oh, boy, that's money on the table. But then if they come back down, well, then maybe the IPO investors were right and the retail investors were wrong.
Well, firstly, we're still so far above issue that, we've got a long way to go before that comes back. But I mean, when I say these IPOs were failed, what I mean is they were dramatically mispriced. And I think that is not in dispute. Whether they come down over the next couple of weeks or not doesn't change the fact that they were told by advisors one night, your company is worth X. Not 12 hours later, it turns out the company is worth 2X. Like that is an unacceptable lack of precision. And the afflicted party are the shareholders at the time of the IPO, the employees, the venture capitalists, management. I mean, those are the people who get unnecessarily diluted by these consistently underpriced IPOs that benefit the buy side. They benefit the hedge funds and the mutual funds at the expense of the startups, of the venture capitalists and the employees that put in the work to create these companies.
Yeah, but when do we really determine what these companies are worth? Because a lot of people would argue right now the entire market is mispriced. People looked at Snowflake and said, oh, my goodness, how could they put that price on it? And I'm not saying coming down one way or the other, but there's one group of investors that's coming in kind of from an institutional point of view saying, maybe we want to be investors in this for a long time. Here's what we're willing to pay. Here's what we think it's worth based on our calculations. The Robinhood investor, the retail investor, might just be looking to trade in and out of this thing, and that's not the kind of investor that the company wants, right?
Yeah, well, and we saw this in 1997 to 1999, which feels like a million years ago. But remember, all of a sudden, it went from costing a couple $100 to place a stock trade and having to do it by phone to all of a sudden you could do it online on E-Trade, Scottrade, Ameritrade, et cetera, for $10 to $50, which at the time seemed like incredible savings. And that drove a huge burst of retail interest into the stock market and drove that early bubble, 97 to 99. And now we're seeing some of it again, where retail investors are now trading through Robinhood for free. And that's generating a lot of interest, especially in these kind of retail consumery names like eventually a Roblox or a DoorDash, which is already public, or Peloton, which are companies and brands that people as consumers understand. To answer your question of when do we know what these companies are worth? Well, every single day the market votes instantaneously on what a company is worth. Over the long term, these things are very efficient. And over the long term, the true value of Airbnb or Peloton or any of these companies will present itself. In the short term, it's almost always mispriced, almost always too high, or almost always too low. The chart of these things are sawtooth, and over the very long term, they tend to be efficient. Over the short term, they're never accurate.
Spencer, as for the SPAC element, now we got the street trying to put some numbers in aggregate on the dollar amount of acquisition targets that are going to have to be bought in the next 18 to 24 months, and what that's going to mean for capital raising and M&A in the year to come. I mean, what's your thinking about what that's going to look like, and whether or not there are enough attractive targets to buy?
Yeah. Well, I think there are, and obviously I'm a SPAC sponsor. I have a SPAC, so obviously I think there are enough great targets for great SPACs to buy. The reason SPACs are having their moment is because they offer a more efficient way for private companies to go public. It's faster, it's easier, the companies can give projections. There are a lot of advantages to going public through SPAC mergers. And as a result of that, the pendulum is really swinging in favor of SPAC mergers as a way to go public. And that's generating a lot of opportunity, a lot of deal flow. So yes, to answer your question, there are plenty of great private companies that will make for great SPAC merger targets. That having been said, yes, there are too many SPACs. There are not too many good SPACs, but there are too many SPACs, meaning that in 2021, you will see some SPAC failures for sure. And there'll be two types. There'll be SPACs that don't get their deal done within the 2-year window. And there will also be SPACs that do get a deal done and the deal breaks issue. And that SPAC takes a company public that doesn't perform well as a public company. Now, that happens in all asset classes. There are busted private equity deals. There are busted traditional IPOs. So this really shouldn't surprise anyone. For me, the important thing as a SPAC sponsor is to make sure that we're highly selective, that we're finding a great private company that is ready to be public, that can also benefit from the advantages that a sponsored IPO provides, which are manyfold. If I could just kind of explain the different life stages of a company. So if you've got an early stage private company, 0 to 10 employees, there are early stage seed investors like a Y Combinator or as an incubator or founders fund that invest at that stage. If you've got a 50 to 150 employee company, a startup, there are venture capital firms like Sequoia, Greylock, Excel that invest at that stage and do a great job. 200 to 500 employees, there are late stage growth companies like TCV, Tiger Global that invest at that stage and do a great job. SPACs are trying to fill this hole between the late stage growth and the public markets. And in that late stage growth, there's a lot of advice and counsel to be provided to companies in the 6 months before going public and the 2 years after. And there are sponsor groups like mine where we've done it before. We've taken companies public before. We've run public companies before. That transition from private to public is tricky. Finding your footing those first couple of years once you're public is tricky. And great SPAC sponsor groups can help those private companies through that life stage. So SPAC sponsors aim to fill a gap between late stage growth and hedge funds and mutual funds that buy public companies. All of these investor groups get paid the same way. Limited partners give them money, they invest that money, and they earn a promote, or 20% typically, of the profits of the investment. So SPAC sponsor groups aren't all that different than any of these other type of investor groups.
Shepard Smith here. Thanks for watching CNBC on YouTube.